In the last 50 years, the actual value of the US dollar has plummeted a jaw-dropping 86%. A dollar in the early 70s is worth approximately $6.99 today. For perspective, a buck could get you not one but 6 Hershey's bars plus a few cents in change in the early 70s. Today, you can't even buy one. Now imagine you had cash stashed under your mattress or in your bank account since the 70s. You would basically have lost 86% of that money's purchasing power. This is the cruelty of inflation, and, as we know, history repeats itself. So how can you protect your money from rapidly losing value in 5, 10, or 20 years? My name is Alex, and the purpose of this YouTube channel is to help you reach financial independence as soon as possible. If you find this helpful, please consider subscribing and hitting the bell icon. It's totally free. Now let's get back to the video. In this video, we delve into 10 tried and tested strategies to protect your money and wealth from the claws of inflation. So, stop chasing after deals to save some bucks, and instead, implement these tips to keep up with the rising cost of living. First off, what is inflation? Inflation is the increase in the general price of goods and services, such that each currency unit buys less and less goods and services. Inflation is the reason you're paying more for gas, and your grocery bill has shot up. It's not that these goods have gotten expensive, but that your money has just gotten worse. How to protect your money from rising inflation. Buy gold and other precious metals. Ask any seasoned investor what is the safest asset you can buy, and they will probably tell you gold. Gold has been used as currency as well as a store of value for over a millennium. In fact, it was so highly valued that kings would accumulate and wear gold to exert power and display wealth. Some, like the ancient Egyptian rulers, were even buried with it. That said, many countries around the world, including the US, have historically backed their currency with gold. That is, until the US abandoned the gold standard. Today, the Federal Reserve holds a combination of gold and paper money. Still, gold is just as valuable as it was 1,000 years ago, with investors buying massive amounts of it when there is an ongoing or rumored economic crisis. So, what makes gold such a great hedge in times of inflation? It shares an inverse relationship with the dollar, or currency for that matter. That means the higher the price of the dollar, the lower the price of gold. And when the dollar plummets, which is what happens during inflation, gold prices go up. Therefore, if you have some of your wealth in cash, you might want to convert that into gold bars or gold coins. You can buy gold from any approved gold exchange and have it stored in a safe or gold depository. Look into the commodities market. Now, the common trend during high inflation is that everything tends to go up. And it's not just consumer goods that increase in prices, but raw materials too. We are talking about oil, gas, metals, and even corn, wheat, and so on. In investment terms, these items are known as commodities. Commodities are an alternative asset class that acts as a great hedge during inflationary times. Basically, the value of your commodities investment will go up as the currency purchasing power diminishes, protecting you from loss as opposed to if you were holding that money in cash. Purchase more real estate. Have you figured out the trend yet? Tangible assets typically do better during times of inflation. So, aside from gold and commodities, you can also put some money into real estate. The benefits of investing in real estate are actually enormous. Depending on the type of real estate investment you pick, you can enjoy steady income, decent returns, and even tax breaks. More importantly, you get to shield your wealth from the harsh effects of inflation. During times of inflation, the price of housing also goes up. Basically, the value of your real estate investment appreciates. And if that piece of property gives you income in the form of rent, that also increases. However, you want to keep in mind that mortgage typically also goes up during inflation. So if you finance your property investment through debt, you're going to pay more during tough economic times. Acquire Treasury inflation-protected securities. When investing during inflation, you want to either go with assets that rise with inflation or that are cushioned against inflation. TIPS is part of the latter. Treasury inflation-protected securities, or TIPS for short, are a type of U.S. government bonds that are tied to the Consumer Price Index. What does this mean in lay terms? The Consumer Price Index, CPI, is an average measure of how much consumers are paying for goods and services. This metric is used to track price changes over time and is often used to calculate inflation. TIPS are tied to CPI to protect investors from inflation. So when the prices of goods and services go up, The principal amount you invested in tips is adjusted upwards to match the change. Now remember, this type of investment is a two-way traffic. During deflation, your principal amount tends to go down as it is adjusted to the lower prices of goods and services. Consider companies that have historically outperformed inflation. Now, no doubt the stock market is volatile and frankly quite scary in times of high inflation, more so for investors with low risk tolerance. But you can still invest in stocks, but with a little more care. Basically, you want to select companies that have historically survived economic recessions. More importantly, the ones that have previously outperformed inflation. Investing in these stocks is more likely to shield your wealth and, in the best case scenario, give you pretty decent returns. If you are not sure about particular stocks, funds too, like the S&P 500, are also a good option. Spread out your risk among different asset classes. During high inflation, you want to have a mix of assets or investments. You definitely don't want to have all your eggs in one basket, as this can go sideways pretty fast. Why, you ask? You see, different assets react differently to inflation, and even those who move with inflation usually do so at varying degrees. So don't ditch some assets completely because they have dropped with inflation. Rather, readjust your portfolio by reducing your allocation to these assets in favor of stable asset classes, such as the ones we have covered in the first 3 points in this video. Expand overseas. The world is increasingly becoming globalized, which means you don't need to confine yourself to your national border when considering investments. One advantage of looking beyond your jurisdiction is that you may find markets where inflation is much lower. Yes, while the US has the biggest economy and does hugely influence the global economy, that does not mean what is going on within the borders is necessarily happening outside it. There is almost always somewhere where the markets are better. So wherever you are, you just need to open your mind and of course familiarize yourself with relevant regulations. Consider growth assets. Are you a high-risk, high-reward kind of investor? Growth assets might just be what you need to ride the inflation wave. A growth asset is a type of security that focuses on capital appreciation. So instead of putting your money in a savings account, for instance, to only earn interest that is then negated by rising inflation, you can invest in equities, infrastructure, or property with the potential to grow your capital while also giving you a share of the profits. The opposite of growth assets is defensive assets. The latter comes with low risk, but also low reward. That said, this asset class is risky, especially in the short term, so be sure to put what you can afford to lose, or at least wait until it gives you sensible returns. Put some money in short and midterm bonds. When inflation is in the offing, you can weather the storm by also investing in short-term and midterm bonds. That is anything between 3-5 years of maturity. If they can give you a return of 3% of the average, then you are good to go. However, you absolutely want to avoid long-term bonds. You see, bonds are a fixed interest security, which basically means that as inflation rises, the real value of your return diminishes. So, if the maturity period is long, you actually end up losing money. Don't make quick decisions based on the current figures. All things considered, it's not just about deciding where to put your money to avoid inflation, but also making the right call given the market trends and sentiments. So, avoid making quick, drastic decisions regarding your investments. Instead, have a long-term approach and avoid investing based on emotions. If you want to learn an effective method that can help anyone retire in 10 years, even on an average salary, then click on the video that appeared on your screen right now because you can't miss the chance to learn more valuable knowledge for free.